In this video, we are going to discuss the use of asset allocation and risk profiling. If you use risk profiling software, chances are the risk profile evaluated from the test will give a recommendation for the percentage of growth assets the plan should hold to meet their evaluated risk profile. Financial mappers will help you plan asset purchases and sales which will meet the recommended risk profile. We are going to make a very simple 20-year savings plan. The client is a couple aged 45 years and have just inherited $500,000. They are seeking advice on the management of this money. Let's look at the starting position. They are both working with salaries of $150,000. They have indicated in the milestones that they wish to purchase an investment property with part of the inheritance which is currently in the transaction account. They own their own home valued at $800,000 and have no debts. Mary has an industry fund super account, John has a SMSF, but his information must be entered directly into the plan as the details are too complex for this simple data entry. They plan to invest 10% of their salary until they retire. A plan is now created using the starting position information. First, we must add the details of John's SMSF. This is going to be a joint SMSF, but only John's employer contributions will be added to this account. John has $500,000 in employer contributions and Mary has $100,000 in pre-tax contributions which are assigned to shares and managed funds and cash. In addition, they have a small investment unit valued at $350,000. This property has a $100,000 loan which will be repaid over the next 20 years. In their shares and managed funds account, the account defaults to 100% Australian equities, as many people with an SMSF are self-directed equity investors. But in this case, they have assigned 50% of funds to defensive assets and 50% to growth assets. Note how easy it is to change the asset allocation. They plan to assign 30% of all new contributions to the purchase of shares and managed funds. Let's look at the graph for investment profile. They are maintaining a balanced fund. Next, you can review the asset allocation. Because the cash account is used for paying the fund's expenses, the percentage held in this account is decreasing, but this could be adjusted if required. Let's sell 20% of the shares and managed funds in year 15. Now the cash allocation has been rebalanced. The third graph displays the percentage of growth assets. In the background, three coloured bands describe the areas as conservatives, balanced and growth. This is similar to the graph on the ASIC's Money Smart website. Now we are going to Mary's superannuation account. Mary wants to reduce the percentage of growth assets as she moves closer to retirement. Initially, Mary has an aggressive fund because she is still young enough to recover from any adverse events. By selecting aggressive, the program automatically selects a suitable allocation. However, you can overtype this allocation if your superannuation fund has given the asset allocation for their aggressive fund. The allocations are cash, domestic and global fixed interest, domestic and global equities, other investments which would be items like precious metals, and finally, property trusts. After the first 5 years, Mary is moved to a high growth fund, which she expects will earn 10%. Watch the change in allocation as we go from the default balance fund to a fund with high growth. See, there are less defensive assets which are displayed in the shades of blue. For the 5 years before retirement, Mary was a balanced fund. On the graph, the investment profile is moving from aggressive to high growth to balanced over the 20-year plan. The asset allocation has also changed over these 3 periods. Finally, look at the percentage of growth assets. They move from 90% growth assets to 70 to 50. Using $200,000 of their inheritance, John and Mary plan to purchase an investment property and they will repay the loan over the next 20 years. Next, the plan is going to establish 3 managed funds. The first will be a corporate bond trust. The asset allocation will be 50% each in domestic and global fixed interest. They plan to invest $80,000. This money is withdrawn from the transaction account which was holding their $500,000 inheritance. The second fund will be a property trust. Watch the graph as the asset allocation is changed from a balance fund to a 100% property trust, which classifies this trust as aggressive. Again, $80,000 will be used to purchase this property trust. Finally, the last trust will be a general all-purpose balanced fund. This is the default entry for managed funds. Note the balanced funds has 50% defensive assets and 50% growth assets. Now we have to complete our investment plan. As Mary wants to contribute to the SMSF, she will need to activate this account. For the first 10 years, 20% of the funds after the payment of the investment property loan costs are going to be allocated to each of the managed funds and Mary's pre-tax contributions. In years 11 to 20, 60% of the funds will be allocated to the balanced fund and 20% to the Mary's pre-tax SMSF contributions. In the last 5 years, all the allocation to managed funds will be to the corporate bond trust. This will increase the amount of defensive assets as John and Mary move closer to retirement. The review page is the best place for you to get a quick review of your plan. Watch how the asset values grow and the loans decrease as you move the slider. All values displayed are in preset value. The values for assets and liabilities are at the end of each year. For each dial, a graph gives you more detailed information. This is the hub, where you can carefully explore the main components of the plan. The investment strategy displays the percentage of growth assets for investments excluding retirement accounts. I will quickly open a few of the other graphs. Home. Investments. Retirement accounts. Transaction account. Note how the additional cash has been kept in the transaction account rather than opening a cash account. Investment loans, which will be repaid by the end of the savings plan. And income, which shows the combined salaries. Now we move to the report chevron and examine the plan outcomes in terms of asset allocation and risk profiling. We start with an overview graph which shows your asset allocation with retirement accounts as one value. In this case, about 60% of assets are held in super. Note how the value of cash, term deposits and bonds increases as the plan moves towards the end of the plan and the start of the retirement, which would be the year after the end of the savings plan. For simplicity, only graphs relating to investments excluding retirement accounts are displayed. However, the same graphs are available for retirement accounts and the total for use in reports. The investment profile. It remains as high growth throughout the 20-year plan. With the asset allocation, note how the majority of the funds are real property at the start of the plan, but as the plan progresses, more defensive assets are added. In the last year of the plan, real property is 38% and property trust is 18%. The last graph referred to as your risk profile details the percentage of growth assets. What if John and Mary wanted to have a portfolio of balanced investments in the last stages of their plan? Let's see what happens if all the funds in the property trust were sold at the end of year 15. The investment profile for the last 5 years is now balanced. The allocation of defensive assets is increased and the percentage of growth assets has decreased to 53%. The data view gives you much more detailed information. This detailed information is given for investments, retirement accounts, and the total, which combines the two. Watch carefully as I click through the 4 5-year periods and see how the investment profile changes. If you wanted more detailed information, the risk profile giving you the percentage of growth assets is listed below for each category. The asset allocations give you both the dollar value and percentage for each of the 8 categories. Again, this information is given for investments, retirement accounts, and the total. Asset allocation and risk profiling is an important part of making a great financial plan. That concludes the discussion of asset allocation and risk profiling.